Basant Maheshwari, famous investor, author, and portfolio manager, joins us. He represents Basant Maheshwari Wealth Advisors. Basant, I want to move beyond budget and implications of long-term capital taxes, because today we are discussing it. 3 months down the line, it will be part of the system, and nobody will remember it, and life will be back to normal. But what the budget has done is that it has ensured that interest rates will not go down and bond yields will go higher. And typically when bond yields have gone higher in the past, it has impacted stock market valuations, and it has also impacted financial companies and NBFCs and HFCs. So let's take the conversation forward. HFCs and NBFCs have had it easy because interest rates for 3 years have come down, but now the reverse cycle is staring at us.
Good morning, Nikunj. A couple of things to see is when interest rates are normally a pass-through. So the problem when interest rates go up is people do they go up enough to make things unaffordable for anyone? So that's the first thing. And secondly, when the interest rates are coming down, you look at the spreads and the NIMs of all these NBFCs and the HFCs and everything, the spreads were not expanding. So obviously it's a short-term deterrent, but on a broad scale, stock markets don't swim against the tide. So when interest rates go up, it's normally an overhang. And right now, the investor is stuck in the crossfire of interest rates, bond yields, and LTCG. He doesn't know which way the bullet is coming, but the bullets are really coming on him. So I think more than the NBFCs and the HFCs, right now investors have to be very sure about the small craps which they pick up, because over the last 2 months it seemed that the Bombay Stock Exchange would solve India of its poverty problem. You buy a stock at 30, it went to 50. Things don't happen so easily in life, and it was very clear that this had to happen, and it's happened. And it's a violent, the problem in today's market is everything happens in an knee-jerk reaction. So if the Nifty were to fall 600 points over a period of 3 months about 20 years back, all that would happen in 3 days now, because everybody wants to get in and get out at the same door. So that's a problem, and we are taking it. But still, the only way to handle this bear onslaught, temporary or permanent, I don't know right now, 2 people can save you. One is earnings, visibility, and growth, and the other is God. So God, we don't know whether he'll come to save you, but earnings, visibility, and growth could.
That you do right now, I mean, do you already keep that shopping list ready? Do you already start buying at these corrected levels? Or do you think this market is going to have a more lingering impact as world markets try and adjust to a changing money environment wherein money is not going to be all that cheap, quantitative easing is going to end, and yields across the globe try and adjust to that reality?
What you buy is more important than when you buy. So it's not a question of whether you buy 10% down or 10% up. A stock is hitting circuits and it's already down 50%. The poster buy of this bull market went up 20, 30 times over the last 3, 4, 5 years. Vakrangi, we all know it. No recommendation. I'm just explaining it for the sake of a discussion. So you buy it 10% higher, 10% more, it doesn't make a difference today. There's no exit for you. But if you buy these high quality companies, at least when the bear comes along, you can somersault yourself back into a sand bunker and be safe. So you'd rather be safe behind quality and earnings, and you know what the names are. So investors should give up the idea of getting rich over a few months and weeks. I think you have to buy companies with strong fundamentals. It sounds cliched, but it couldn't have been more important than a time like this. You buy a company, it goes down 10%, 20%, doesn't matter. You can sleep well at night. For example, people say stock market, you don't need any effort to make money. But the guy who's put all his money in, and we are people who don't put all our money in, we put all our net worth into stocks. Then you have to wait till 12 to look at the Dow and then get up early at 4 o'clock to see what the Nikkei is doing. If that isn't effort, I don't know what is.
That you start buying, wherein you can safely ignore the price, you know you're buying into quality, and you know that even this 10% fall is an attractive level right now. Where is it that you would first go in and buy?
All the headline stocks, all the frontliners, the Nifty stocks, no recommendation, just I'm throwing names at you, maybe a Maruti, maybe an HDFC Bank, maybe an Eicher Motors, I don't know. I mean, you can go wrong 10-20% here and there. This is for the normal guy. But forget the idea of buying into that small cap index. Those 500 crore market cap companies which somebody writes about on a social networking site. I mean, it's very difficult to find an exit there. And money isn't created by making 10, 20% gains. Money is created by buying stocks for 5, 7, 10 years. So I think the first focus should be to focus on the large caps, on the mid caps, companies with more than $1 billion in market cap. That's a good way to start. So anything below that, because I think the market will be clearly dichotomized now. Over the last few months, people thought that they could make money from kachra, but now they will understand that paise ka hi kachra ban jayega. So I'm really afraid, and maybe I'm scared about these smaller companies, the 2, 3, 400 crore market caps that were going around. But for the big names, we bought on Friday in the second half. I'm completely invested, more than 100% invested. I intend to remain that way. Because I think after this, again, it will be back to earnings and growth. And I mean, I was really not able to get a grip on the market, what was happening over the last 2, 3 months. But now, I think once this settles down, the first sign of Nifty recovery, the stocks should start going up, the stocks should start to come in the green. I think they are the ones you should look at. Obviously, they have to be backed by earnings and growth and quality and management, all that.
Basant, having said that, a lot of good quality mid-cap stocks have already corrected, whereas Nifty is not far away from its all-time high. I was looking at a list of mid-cap stocks which have fallen. A stock like Arvind Mills or, something like Eicher Motors, some of these stocks have corrected 15, 20, even 30%. So do you think the correction in good quality mid-cap stocks is already over? Rather than focusing on those 40, 50 stocks, one should look at A quality mid-tier stocks because they've corrected? I mean, if the bull market is still intact, then 25, 30% correction is the maximum you will get in a good quality mid-cap stock.
Absolutely. I mean, the bull market is intact. The bull has got a toe fracture because he took a long route, because he took a different way. He hit his leg on some rock and now he will be fine. I think he'll be back to the original mode. I mean, the two names that you mentioned, no recommendations, but any of them, buy them 10% lower, buy them now. If they fall 10%, you don't lose sleep. You can just keep quiet and wait for them to go up. I mean, these are the kind of portfolios people are supposed to build. Of course, I don't own them because we own our HFCs and one of them should see a big corporate action over the next 30 days. We're waiting with bated breath for that as to who's going to pick up the... See, one thing, Nikunj, I'll tell you, if the girl is beautiful, she'll find a boy. That's not a problem at all.
Well, if there is a pretty girl, she'll always find a suitor. But, Basant, my follow-up question really would be that a week ago, we were using this Hindi analogy of Ek anar, 100 bimar, right? There were few good stocks and there was too much of money which was chasing those stocks. How come so much of liquidity argument which was taking this market higher has turned suddenly to 1 day of correction after a great 2017 and a super 2018? And, I'm getting all bearish comments as if hell has broken loose. I mean, it amazes me how the market psychology shifts and changes not because of fundamentals, because of price.
So of course, everybody was chasing price, but the liquidity argument has to be looked at in a context of who was providing this liquidity. The guy was doing a 2,000, 3,000, 4,000, 5,000 rupees SIP. He's never seen a drawdown. Demonetization came and went. So before he could react, the stocks were up, right? Brexit came and went. Before he could react, the stocks were up. GST teething troubles came and went. Before anything happened, the stocks were up. So if there is a prolonged phase, the guys were doing their SIPs. Of course, they should be investing more at that time, but stock market, Nikunj, everybody cannot be rich at the same time. So if there is a prolonged phase of bearishness, all those guys will stop putting in further SIPs. If the bearishness continues, then they start withdrawing. So you want to be with the best of the lot. You don't want to be dependent on somebody else's liquidity for you to make money. You want to be dependent on the companies that you have bought to make money. So this liquidity argument is good as long as the market goes up. But markets normally top off. I'm not saying this is a top off for the entire market, but it's certainly a top off for the real small cap kachra companies. So markets top up on leverage, liquidity, and optimism. And the one thing which is really worrying me is over the last 3 days, nobody is saying that the best has happened. People are saying it's a correction. Not that I am bearish, I'm more than 100% invested, but I'd like many people to say, hey, the bull market is over, because that's the time it doesn't get over very fast.
So Basant, the heart of your portfolio, a large part of your portfolio is HFCs and NBFCs, and we know that. Is there any reason for me to believe that you could be changing your positioning there purely because better options are available elsewhere, or you're still committed to remain not overweight but mega overweight in those sectors?
No, we own HFCs, NBFCs, and obviously the consumer names. I bought on Friday evening some HFCs, so for Friday afternoon. I intend to be that way. The companies are growing at 20, 30, 40%. One of them will see a huge corporate action. It's already there on the BSE website. So on the consumer names, it's growing at 35, 40%. Steady company, it's going to take away market share over the next 5, 7, 10 years. Of course, I don't know whether I'll own them for the next 5, 7, 10 years, but in the immediate future, over the next 1 to 3 months, there are no thoughts of changing it. But then it's a market finally, we can sell anything and do anything. So that's how we should put it.
Always a firm believer in HFCs, and that's what he's buying. That's the word coming in from Basant Maheshwari. Basant Maheshwari, thanks so much for taking the time out and speaking with us today. Always good to chat with you and get in your views on the markets.